Well, the local currency has underperformed the euro's recovery in the past year, while it is testing critical support levels against the US dollar. For more on the currency market, I'm now joined by Brigid Taylor. She's head of flow sales at Nedbank Capital. Very good morning to you, Brigid. It seems as though the Greece issue again taking the spotlight, and you came in here blazing and saying we don't actually probably understand how huge this is, and it's more than just Greece. It's about the overall picture and the sentiment that it would send to the markets about the entire eurozone.
Absolutely. I think, at the end of the day, markets are run by sentiment. So it's not necessarily, I think the market can price in the fact that Greece will probably default at some point, etc. But ultimately, the problem is bigger than that. What does that mean for Portugal, Italy, Spain, and Ireland? These weaker southern states in the eurozone. What is the knock-on effect going to be on that? If they allow one state to go, why can't they allow others? If they bail out one, why don't they bail out others? So, what applies for one has to apply to the same. It's a mother with 3 children. You have to be kind to everybody. So it's about managing those expectations. And right now, with the political noise in the system, you've got the Greek parliamentary press bantering with the French and the Germans. This is becoming a political noisy situation, which does not bode well for market sentiment. So you're not getting the result. We're in week 3, groundhog week 3. We in the same scenario, and nothing has changed. But what has changed is that the outcome looks to be further and further away. And in fact, if not anything, post the elections, which is post that bailout deadline date, and that's punishing markets today. We've seen the euro off 2 cents.
Now, what is going to happen? Because politics is a huge issue here. Now, one of the things that I was saying to you is that the logic does make sense in a way of saying we have to wait for those elections, because how do you know who's going to be in power? The person that could, the administration that could come in could say, well, we didn't agree to this. Yes. So then we've got probably a problem again happening.
Well, you've hit the nail on the head, and I think that's the big concern, because initially they wanted a unanimous vote to come out of Parliament to buffer against exactly that outcome, because they know there's elections in April. They need to ensure that these policies that are now put forward on paper can be implemented, have the sustainability and the longevity to ensure that Greece is a sustainable partner in the eurozone. Unfortunately, they got a majority vote, but they didn't get everybody's vote. And what does that mean when you vote in April? Are those non-voters going to then be policy makers going forward who don't necessarily agree with the austerity measures that have been agreed now? So that's really where the uncertainty lies, and I think Troika is very aware of that, and that's why there's been a lot of talk about doing these bailouts or agreeing to all of the bailouts post the elections once they know who's going to be in the power seat. And unfortunately, that is a little bit too much too late.
So come the March deadline, Greece defaults, what then?
Look, I think, at this point in time, I think there's still a lot of debate that's going to go under the bridge. We've got a while to go before March 20th. It's a month away if you think about it. So in these kind of markets, you're going to hear a lot more noise from the politicians. But ultimately, I think the market is hoping with all optimism that they're going to make a plan, that something will give, that the bailouts will be given with predetermined criteria, etc., but that all will be fine and the skeleton will remain in the closet. The problem is, if that doesn't happen, and there is in fact a Greek default, I don't know that we actually understand the contagion effects and the way that the market will punish the likes of Portugal, which will then have a knock-on to Italy, Spain, etc. And the southern states in Europe potentially remain under a lot of threat. And I think that this is what they know, and they can see that threat. So from that perspective, for now, the trend has been very positive. We've seen equity prices rally. We've seen positive data. We've seen emerging markets do well. We've seen commodity markets remain relatively strong. Despite all the noise in the system, because the market lives in the hope that there will be a deal reached. Unfortunately, like I said earlier, we're in week 3, and the unfortunate thing with that is that people start to lose hope and start to look again at the possibility that it may not come to fruition.
We're having a bad day on the market today, but it's just a day.
Correct.
And you were saying that it worries you what could happen in the second half of the year.
Correct.
You said we will see carnage like we don't know it if this particular problem is not dealt with and dealt with speedily.
Correct. I think, I think the big risks in the system is that the kind of bailouts that they're talking about, specifically within the eurozone and all of the states, it's a huge bet, because they know that ultimately the weaker states are a very small percentage of the total GDP, and if they can keep those alive, they keep the sentiment right for the stronger states, and hopefully that injection of cash, repurchasing of bonds, etc., plays catch up into a market that slowly starts to see some form of sustainable growth, which then they can start to exit the cash and exit the lower rates, fight inflation, and sort out the global picture. The unfortunate thing is, if that doesn't happen soon enough, what we're going to see is some form of breakdown, which ultimately will the market will punish it severely, because unfortunately we all know there's a limit to how much cash you can put into this problem, and the limit of the cash is becoming evident.
Do you think there are some traders who are quite negative in shorting the euro right now?
I think anybody that's shorted or has been trying to short this market has been so badly burnt that what we've realized is go with the trend. The trend is your friend for now, but be aware of the fact that it very quickly can change. And we're all wondering and speculating about what that change will be and what it'll look like. But I think ultimately we're all aware that there's a lot of skeletons in the closet. We're just hoping nobody pops out and lands on the floor.
Let's come back to our own currency. Today we're seeing some positivity coming through. What do you think is fueling that?
Look, I think we've had some very good data. I mean, if you look in the global perspective, unemployment's starting to come in line. We're starting to see a little bit more activity on the housing sector. These are these underlying issues that we've been waiting for a while. We've seen South African data come out relatively positively. In fact, our unemployment itself also came out surprisingly lower than what the market had expected. So these kind of things underlying a global outlook of growth, deterioration, etc., just put in a little bit of optimism in a very dire kind of outlook, especially if you look at the fact that a lot of those outlooks have been downgraded. You're looking, you know, in South Africa, we're also concerned about our unemployment rate. We've got our budget coming up. It's going to be interesting to see how that's managed in a politically fired environment. So, you know, I think those all underlying factors. Living in South Africa, though, we've also noticed, because of the foreign participation and a lot more liquidity in our markets, the ranges are a lot more well managed. So, you know, you see a massive sell-off in the euro. You see the rand probably pop 5, 6, 7 cents in a day, which is relatively well managed by emerging market standards. Today we've seen 2 cents off on the euro, yet the rand's only trading at 7.85. So it's, you know, it has popped above that 7.80 level. It opens up 7.88 and potentially 8. But I still think that if they do manage to get a Greek deal on the table, you'll possibly see people participating back into high risk trades.
Let's talk about our bonds. What are they looking like right now going forward, particularly if we do see that default come through, if we see that we continue to delay this rescue package for Greece?
Look, the South African bond market's been largely supported by foreign investors, specifically if you think that a lot of local participants are remaining on the sidelines ahead of our budget, because there's a lot of speculation around issuance going forward, how much will have to be issued, will there be more bonds in the market, etc. So that's kept our bond curve relatively steep. We've seen also the appetite from our foreign investors will be in the less longer end duration than what you're seeing in terms of our real money or long life type asset managers in South Africa. That being said, though, the risk does lie to the fact that either if we don't see continued foreign support, what does that mean in terms of issuance going forward, as well as the fact that foreign support has kept our bond market relatively strong. And if that doesn't happen, potentially we could see that ratchet a lot higher, as well as the fact that we're in an interest rate environment that is now looking, obviously in the long end, but looking for hikes at some point.
Thank you so much, Brigid. Brigid Taylor, she's head of flow sales at Nedbank Capital.